So let's take a minute and look at a couple of firms that are in similar lines of business, and let's look at how this context could work. So let's take a look in table 3.6 in your textbook, the financial information for 2011 for Lowe's and Home Depot. And we'll see that Lowe's and Home Depot are both large companies. We're looking at $50 billion of sales versus $70 billion of sales. $1 billion, almost $2 billion of net income to almost $4 billion of net income. These are very large corporations. And we see that we have current assets, current liabilities, all that information. And it's a little bit overwhelming because there really isn't a point of comparison or context for what's going on. But if we look at the price per share of the stock, we see that Home Depot is worth about $45 and the Lowe's stock is worth about $27. So not quite twice as much. We look at the book value per share though, and Lowe's has a book value per share of 13.78, where Home Depot has a book value per share of 11.78. Now this is kind of interesting because the accounting value of Lowe's is higher than the accounting value of Home Depot, but the market value or the price per share of Home Depot is higher than that of Lowe's. So we kind of have a different something going on here. Why would the market be valuing Home Depot higher if the accountants value Lowe's higher? Well, we can look at a couple things. First of all, their current ratio. We see that Lowe's current ratio is 1.28 and Home Depot's is 1.55, which means that Home Depot is more liquid than Lowe's is, which means that they're probably a little bit better financial shape than Lowe's is. Then we look at the debt to equity ratio, and we see that the debt to equity ratio for Lowe's is 1.03 and the debt to equity ratio for Home Depot is 1.26. Now that means that Home Depot uses a little bit more debt relative to Lowe's. You might say, well, but more debt is bad. That's not always the case. For personal finance, more debt is not really all that good. But for corporate finance, what we talked about when we talked about the equity multiplier is that the more debt we use, the greater the earning power of our equity. And so analysts are probably looking at that higher debt to equity ratio and saying, well, Home Depot is going to be able to leverage their equity returns higher, so they're probably a little bit better investment. Total asset turnover. We just covered that, and that says that what kind of job is the manager doing in utilizing the firm's total assets. In other words, how many dollars of sales do we get per $1 of total assets? For Lowe's, we get $1.50 of sales per dollar of total assets, whereas Home Depot, we get $1.74 of sales per $1 of total assets. So on the total asset turnover, it looks like the Home Depot management is doing a little bit better job of increasing their utility, their use. The profit margins also show a big difference between Lowe's and Home Depot. Home Depot has a higher profit margin at 5.52 than Lowe's does at 3.66. And the return on equity for Home Depot is much larger. Again, that's some we'll talk about in the coming slides. That has to do with that equity multiplier and the leverage using debt to magnify the earning power of equity. ROA is much higher, so they're much more profitable. Home Depot is much more profitable than Lowe's. And the market to book ratios indicate that Home Depot may be a little bit Home Depot may be a little bit more valuable than Lowe's relative when we compare the market to the accounting value. The last thing is the price to earnings ratio. We said a lower price to earnings ratio is probably better. And here we see that Home Depot has a little bit lower price to earnings ratio than Lowe's does. So we might consider it to be a little bit better investment. So let's think about a way that we can put all of these ratios into a context. The DuPont identity is a method that we can use to put all of these ratios into context. And the DuPont identity begins with the definition of ROE, return on equity. The basic formula for return on equity is net income divided by total equity. Financial analysts at the DuPont Corporation worked a way for us to break down or decompose that basic formula into what we call the DuPont identity, which allows us to measure three major sources of management decision making and how that affects the firm's financials. So we could rewrite ROE as the profit margin multiplied by the total asset turnover multiplied by the equity multiplier. That is the DuPont identity. And we'll show you why it's an identity in just a minute. Profit margin, we know, measures profitability. Total asset turnover measures asset use. And equity multiplier measures financial leverage or debt use. And all three of these areas are areas that our management can have an impact on the firm's operations. So using the DuPont identity is sort of a game plan about how we're going to think about the firm's activities. So again, the profit margin portion of the DuPont identity measures our operating efficiency and how well do our managers control cost. The asset turnover measures our asset use efficiency and how well does the management manage its assets. And the equity multiplier measures financial leverage, remembering that if we use debt, it allows us to buy more assets and magnify the earning power of the equity that we have. So let's go back to our Prufrock Corporation ratios that we just looked at a few minutes ago. And let's use the items that we calculated to compute the ROE based on the DuPont identity. If we have a 15.7% profit margin, a 0.64 asset turnover, and a 1.39 equity multiplier, when we multiply those three numbers together, we get 14%, which is what we basically got when we computed ROE before. We have a little bit of rounding error, but that's okay. One of the things that we're going to use some of these ratios for, and a way that we're going to think about, is how we can identify how much growth the company has available to it. So we're going to calculate a couple of different measures of growth. The first is the internal growth rate, and the second is the sustainable growth rate. Before we calculate those growth rates, though, we're going to have to work with some of the things that we're going to need, some of the components that we're going to need to compute those growth rates. So the first thing is we want to talk about what's the dividend payout ratio. The dividend payout ratio we can think of two ways. One is the dividend per share divided by the earnings per share. And the other way we can think about it is the total dividend divided by the total earnings or the total profits. So if we think about it the second way, it's really easy. We go to the income statement, we pull the dividend number off the income statement, and we divide by the net income number off the income statement. And that'll give us the dividend payout ratio. Now your book is going to call this 1 minus B. Okay, that doesn't make a lot of sense right now, but it will in just a few minutes. The flip side to the dividend payout ratio is the retention ratio. Right? So we talked about that when we make profits, we can either do one of two things. We can either pay them out as dividends or we can keep them as retained earnings. So the retention ratio says how much do we keep as retained earnings divided by what's our net income. And we're going to call that B. The retention ratio is B. So the retention ratio plus the dividend payout ratio have to add up to be 1 or 100%. So we're going to need to use the retention ratio and the dividend payout ratio as we calculate our internal and sustainable growth. Let's look at an example here. To calculate the dividend payout ratio from Prufrock, we go back to the income statement and we take the 121 of dividends and divide by the 363 of net income, and that would give us a 33.3% dividend payout ratio. Well, if 33.3% of our profits are paid out as dividends, then that must mean that our retention ratio is the rest. So 33.3 subtracted from 100 would give us 66.7. The other way we could calculate that 66.7 is to take our retained earnings of 242 and divide by the 363. And that would give us our retention ratio. So that means we retain about 66.7% of our earnings and we pay out about 33.3% of our earnings. So now we're ready to calculate the internal growth rate. The internal growth rate is how much the firm can grow using retained earnings as the only source of financing. Remember that when we use retained earnings as our source of financing, we don't have to go outside the firm. We're using inside financing or internal financing. So when we use internal financing only, we're going to be calculating the internal growth rate. So you see the formula here. Return on assets multiplied by the retention ratio, all divided by 1 minus return on assets multiplied by the retention ratio. The only thing I'm going to say here is that we need to be a little bit careful and make sure that we remember our order of operations in the denominator. We do the ROA multiplied by B first, and then when we get that answer, we subtract it from 1 in the denominator. Make sure that you pay attention to your mathematical order of operations. So we have an ROA of 10.12%, a retention ratio of 0.667, and we can compute our internal growth rate of 7.23. Now this means that we could grow at 7.23% using only our retained earnings as financing. Now what would happen if we didn't want to use just retained earnings as financing? What if we also wanted to use debt or bonds and raise money to maintain a constant debt ratio? And we'll talk about a little bit in the future about why we want to maintain a constant debt ratio. But what if we wanted to maintain a constant debt to equity ratio or debt to assets ratio, and we're going to issue debt to make that happen? Well, then we'd be computing the sustainable growth rate. The sustainable growth rate tells us how much could we grow if we use retained earnings to increase our equity, but then issued some debt so that our debt to equity ratio would remain constant. The sustainable growth rate formula is ROE times the retention ratio divided by 1 minus ROE times the retention ratio. So again, we have to be careful when we compute, but when we compute the answer, we should get 10.29%. That's a little bit higher than the internal, but that makes sense because we limited ourselves to only retained earnings in the first measure. In this measure, we're allowing ourselves to use retained earnings plus debt. So we have a little bit more capital available to us. So what are the determinants of growth? The first is the profit margin. The profit margin tells us operating efficiency, how we're doing on cost control. The second is total asset turnover. How easily or how efficiently are we using our assets to generate sales? The third is financial leverage. Are we using debt? Are we not using debt? Are we using the optimal level of debt? If we are, we're going to be able to grow more. And then finally, the dividend policy, which is how much we're going to pay our shareholders versus how much we're going to reinvest in the company by retained earnings. So let's look at an example here of Yahoo versus Google. And we'll look at the DuPont analysis for Yahoo versus Google for a 3-year period. And let's look at the most recent year, 2011, and we'll see that Google's ROE is about twice what Yahoo's ROE is. Now, why is that the case? Well, Google's profit margin is higher, 25.7 versus 21. So Google has a little bit better cost control than Yahoo does. Google also has better asset utilization. Their asset turnover is 0.522 versus Yahoo's of 0.337. So Google's using its assets more efficiently than Yahoo is. And finally, Google's equity multiplier is 1.25. Yahoo's is 1.18. So again, Google is using a higher level of debt than Yahoo is. Now let's look at over time what happened here. Over time, Yahoo had a very low profit margin, which has improved quite a bit. So it seems to me that Yahoo, in terms of profit margin, is doing the right stuff. They just haven't gotten where they need to be yet. However, on the asset use, it seems like Yahoo might be going in the wrong direction. They started out 0.433, dropped to 0.424, and then dropped to 0.337. That doesn't seem like that's the right way to go there. Finally, the equity multiplier, Yahoo started at 1.2 and then dropped to 1.19 and then down now to 1.18. So they're reducing their use of debt. So the fact that Yahoo's ROE is not as good as Google's, partially that's because they're not doing the things that Google's doing, but it's also because their numbers are moving in the wrong direction. Now when we look at Google, their profit margin is rising. Their asset turnover has also fallen, which is kind of interesting. Kind of went down and then bounced back up a little bit from 0.686 down to 0.507 and then bounced back up to 0.522. But their equity multiplier took a big jump from 1.12 up to 1.25, and so they decided to take on more debt. They're using their financial leverage to their benefit.